All right, let's talk about that feeling. You know the one. You're watching Bitcoin just launch into orbit, or maybe gold has fallen off a cliff, and this little voice in your head says, whoa, this is getting a little crazy. It's got to snap back, right? Well, that gut instinct, that feeling that things have gone too far, too fast, that actually has a name. It's called mean reversion. And today, we're going to break down what it is, and way more importantly, how some traders try to turn that snapback into a strategy. So the concept itself is actually super simple. Just picture a rubber band. Now imagine its resting state is the average price of something, like, say, the 20-day moving average on a chart. When a crazy news event or a surge of FOMO stretches that rubber band way, way out, tension builds up. And the theory is the further it gets from that average, the more powerful the snapback is going to be. It's basically a bet against the extreme, a bet that gravity eventually always wins. But, and this is the big question, how do you know when that rubber band is stretched to its absolute limit before it snaps? Okay, so this is where things get really interesting. It's not just the prices revert, but how different traders try to play it. There are really two big schools of thought here, two totally different philosophies. We're going to look at both, and we'll start with what you might call the purist's way, the no indicator approach. This quote really nails the whole vibe of this first method. The entire goal here is to get rid of all the clutter. No Bollinger Bands, no RSI, no squiggly lines all over your screen, just a clean chart. The core belief is that indicators are just telling you what already happened. They're lagging. But the price, right now, that's the truth. So how does this work in the real world? It's all about reading the story of the candles. Let's say you see Bitcoin in a strong uptrend. It makes a huge move up, stretching way above its average price. Now, the price action trader doesn't just blindly hit the sell button. No way. They wait. They're patient. They're looking for one specific thing, a sign of exhaustion. Maybe it's a candle with a really long wick on top, a pin bar showing that buyers tried to push it higher but got slammed back down. That candle is the signal. That's the moment they believe the rubber band is about to snap. And the risk management is just as simple. You put your stop loss just above the top of that rejection candle. If you're wrong, you're out fast with a small defined loss. It's all about that patience to wait for the perfect signal. And right about now, some of you are probably thinking, okay, that sounds nice, but it's all a bit subjective, isn't it? And that's the big pushback. Reading candles can feel more like an art than a science. What one person sees as a perfect rejection, another might not. For every trader who loves that clean, intuitive approach, there's another who's screaming, show me the numbers. And that demand for hard data, well, that leads us straight to our second path. Which brings us to the complete opposite side of the spectrum. This is for the traders who live and breathe statistics, the ones who trust probability over their own intuition. Here, we're bringing the indicators back, but not as a guess. We're using them to create cold, hard objective rules that tell us exactly when that rubber band is stretched. So let's look at what a system like this can do. According to analysis from Rainer Tio, one of these strategies has a reported win rate of nearly 70%. And psychologically, that is huge. Think about it. A system might have a simple rule, like if the price closes outside the lower Bollinger Band and the RSI indicator is below 30, then buy. It's a yes or no question. There's no room for fear or greed to mess with your decision. A high win rate like this makes it so much easier to pull the trigger on the next trade, even if the last one was a loser. But here's the thing. A high win rate means nothing if your few losses are gigantic. That's why risk management is everything. This system reportedly churned out an average of 14% a year, and it did it for 25 years straight. A system like this only survives because the exit plan is just as clear as the entry. For example, your take profit target might be the moving average itself, the mean you're expecting the price to return to, and your stop loss, you'd place that just beyond the recent low. Every single trade has a predefined risk and reward before you even get in. And check this out. This is what happens when you combine that statistical edge with ironclad discipline and just let it run. Over that 25-year period, the total reported return was more than 2,800%. I mean, that's a mind-blowing number. But it shows you the incredible power of compounding when you have a systematic process that you follow without emotion, trade after trade after trade. So there you have it. We've got two completely different ways of thinking, both trying to tackle the very same phenomenon, that inevitable snapback to the average. One is all about the art of reading the chart in the moment, and the other is pure science built on probability and strict rules. But they're both pointed at the exact same target. Let's really put them head to head. On one side, you've got the trading artist. They love a clean chart, they trust their skill to read the nuance of the candles, and they believe that every moment in the market is unique. On the other side, you've got the trading scientist. They couldn't care less about the story of the chart. They just want objective signals. Did the price cross this line? Is the indicator at this level? They believe a statistical edge applied over and over is the only path to long-term success. One isn't better than the other. They're just different philosophies for different people. And seeing them laid out like this, it really forces you to ask yourself a question. Which one are you? Are you the artist who wants to feel the flow of the market and trust your interpretive skills? Or are you the scientist who needs the cold, hard comfort of a system that tells you exactly what to do and when to do it? There's really no right answer, but knowing your own personality is key. This brings up an even bigger question. It's not just about how you trade, but what you trade. When you look at the markets right now, do you see more opportunity in mean reversion, betting against the extremes? Or do you see it in the exact opposite philosophy, trend following, which is all about jumping on a winning move and riding it for all it's worth? Especially in a wild market like Bitcoin, is trying to catch these little snapbacks just picking up pennies in front of a steamroller? Or is that exactly where the real edge is found? I'd love to know what you think. Drop a comment below and let us know which camp you're in. Thanks for watching.